Get Rich Education is brought to you by Norada Real Estate, the Real Asset Investor, and Highlands Residential Mortgage.
Are you on track to achieve your financial goals? Income-producing real estate is the most historically proven way to accumulate wealth and has created more financial freedom than any other means. Norada Real Estate provides everything you need to invest in the best turnkey cash flow rental properties. Our simple, proven system will help you create real wealth and passive monthly income. Get your free strategy session with our knowledgeable investment counselors at noradarealestate.com. That's NORADA realestate.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 124. Hi, I'm your host, Keith Weinhold, back to help you build your wealth and sowing seeds of abundance, because the scarcity mentality is abundant and the abundance mentality is scarce. Today finds me in the Eastern Caribbean island nation of Barbados, here vacationing in Bridgetown, Barbados. Yeah, I tell you these things partly to motivate you because, well, this is how you can live if you're financially free with cash flowing real estate. Why wait until you're old to live a good life? So I hope that you're living abundantly this week, living well and giving well. There's one savvy investor out there whom I first talked with a few years ago, and I haven't had the pleasure of hosting him here on GRE until today, and he's going to add some real value to your life. He's become skilled in a real estate investing niche that is intriguing, and we're going to learn about how you can create significant cash flows with this vehicle. Today's guest is a Florida-based real estate investor and serial entrepreneur with over $40 million worth of real estate transactions. His extensive investment experience spans the gamut of apartment buildings, single-family homes, office buildings, raw land, condos, and his favorite, mobile home parks. He joins me from Florida today. Welcome to Get Rich Education, Kevin Bupp.
Keith, thanks for having me. I'm super excited to be spending time with you here today.
Kevin, I think when most people think about mobile home parks, there's this stigma associated with that, and you probably feel like you spent half your life trying to explain the stigma of mobile home parks and maybe dispel it for some people, okay? Because that typically correlates with a certain demographic of clientele that you're serving and the low rent part of town. So, I just got to ask, why mobile home parks and not something like turnkey single-family homes or apartment buildings?
Yeah, sure. That's a great question. And, the stigma is actually one of the best parts of this business because it creates a barrier to entry because a lot of people are scared away from this business. So, the stigma actually can be turned and flipped around into a positive thing. But you're right, Keith. There is a negative stigma attached to mobile home parks. And as I just alluded to, that's one of the benefits because that negative stigma that's attached to them has basically prohibited their growth or from them actually increasing in numbers. In fact, it's the only asset class that has a diminishing supply because most local cities and governments, municipalities, they don't want to be built anymore. So they don't get approved. In fact, they get knocked down faster than they get built. And so that's one of the things that attracted me to this business, aside from single family homes, apartment buildings, and I've owned a little bit of everything. My core that I spent most time in was single family homes and apartments. And I spent a good majority of my investing career in that side of the business. I just switched over to the mobile home park side about 5 years ago. So got a lot of experience in residential housing. And once I learned a little bit more about mobile home parks, I learned about those barriers to entry, and I learned about who the demographic really is, the people that live in these parks. They really weren't much different than the C-class apartment buildings that I was used to owning. In fact, there's a lot of mobile home parks that are quite nice. There's a classification scale 1 to 5, with 1 being kind of what you would equate to like a war zone or like a place you wouldn't want to go to at night. And then a 5-star being something that would be essentially like a retirement destination or a 55 plus community that's got 3 swimming pools and palm tree lined streets and such. So there's actually a wide spectrum of quality of mobile home parks. So the negative stigma is attached to them, but it doesn't necessarily apply when you really dig in and see what they look like and what they really are.
Yeah, a 5-star mobile home park. That sounds like an oxymoron. That sounds like a ghetto resort, just two words that don't go together. But you've obviously found it pretty compelling. You bring up something interesting with the municipalities. It seems like municipalities, they typically would want mobile home parks to go away and hope that better and higher uses surround that mobile home park so they can get a better and higher use in there, shut down the mobile home park, and go ahead and raise more tax revenue. Is it difficult to deal with municipalities? Do they want to deal with you when you have problems and issues?
Yes, it can be very difficult. A lot of the parks we purchase, so I guess it depends on what kind of parks that you're purchasing, because some parks are actually, they're quite nice, they're well run, they're well managed, and so they're not a hindrance on the local resources of the town or the city that they're in. But a lot of the parks that we purchase have some component of distress to them, meaning that, the police spend a lot of time in there, or, they run through the court system quite often. So they're a little bit of a drain on the local resources, and they've kind of built a bad name for themselves. And so in those situations, before we ever buy a park, we actually go meet with the local town officials. If it's a small enough town, we even meet with the mayor. We have done that many times. And a lot of times we do get pushback initially. We've built a little bit of a track record for ourselves now, so we actually can kind of hang our hat a little bit on and say, hey, we've done this at this X number of other places, and it's gone quite well. Here's a recommendation from the mayor of this town. And so now that we have a little bit of track record, it's a little bit easier to actually get their acceptance and to let them understand and help them be on the same page with us that our goal is to make this place nicer. We don't like it how it is, but we're going to spend a lot of money here. We're going to get rid of the trash and bring in quality people and make this place not be a drain on your resources any longer. And so although we do get a lot of initial pushback, a lot of times it goes away pretty quickly once they actually see that we are spending money and we are doing everything in our power to make it a more desirable place to live.
They're probably pretty impressed that you're taking the right approach by being proactive and letting them know what you're going to do first.
You would think. Some of them don't like it too much. In fact, one of the initial parks that we had purchased was a park in the Atlanta area, and we went to meet with the mayor, and he's a gentleman that's about 6'4", with a big handlebar mustache, very intimidating looking guy with stuffed foxes on the wall and like a rifle hanging on the wall. And his first comment to us was, this park was across the street from his office. He said, Kevin and Al, who was my business partner at that time, Kevin and Al, if you buy this park, I'm going to do everything in my power to shut it down. I've been trying to shut it down for 2 years, and so don't waste your money. That's what this big 6'4" guy with the handlebar mustache was telling us. And so that was our initial experience with it. We pushed through anyway, took our chances and bought the park. And that's one of the mayors that actually wrote us a recommendation letter. 6 months down the road, he said, okay, guys, I get it now. Mobile homes or mobile home parks are not the problem. It's the people that are in them. And it's basically the qualification process and the management as to what they turn into. And so he's got a completely different outlook now. And so typically we go through that kind of initial pushback, but it very quickly goes away once they actually see that we're not just all talk. We'll actually get in there and we will change things for the positive.
Okay, so that's external. And then internally, once you have a park, I think a lot of people think, now how do you manage what is generally lower quality clientele that typically exists in mobile home parks?
Well, we have on-site managers that live in each one of our communities. And so we actually have someone on site that lives inside the community. They handle the rent collections. They handle the illegal notices. They handle, enforcing the local rules and the policies of the park. And so they basically are our third-party manager. Although they're not a separate company, they work for us. They're employed by us. They live inside the park. And so they're there. They've got an eye on everything. There are eyes and ears there at the location. Now, as far as the clientele goes, our average park, I guess, in terms of the 1 to 5 star classification range, ours falls like somewhere in like the 2.5 to 3 star. And so that would be equivalent to like a C- to a C+ quality apartment complex. I mean, if you're comparing apples to apples. And so now one of the benefits, you would think that it's a lower class clientele or lower grade clientele in the mobile home parks. But what we found, it's actually slightly better. In fact, again, a lot of it has to do with the management. But if you're comparing apples to apples, what we found is that there's a lot more stability in the mobile home park space, because you have to understand they own their own home. And so they rent the lot from us. They own their own home. And so it's not very easy for them just to pack up and go. It costs a couple $1,000s to move their home, and it's a process. It's very difficult to do. Now, as an apartment, they pack up their backpack, throw their mattress on the roof of their car, and are gone. And so we find that there's a lot more stability, and rents are paid on time more often in that 2.5 star, 3 star park versus a C-class apartment building. Again, they've got a lot more at stake as well. They own their home. And so if they don't pay their rent to us, they run the risk of losing their entire home, which is probably the most valuable asset that they have. Apartment, not so much.
So they're quite a bit less likely to trash their place because it is their place. So the tenant goes ahead and they own the trailer while you own the land.
They've got skin in the game. In an apartment complex, they really don't have skin in the game other than a security deposit. Here, they have a physical residence. Now, often you'll find that if it's a really old beat up home, if we come into a park and we start making changes that people might not like, might be a few people in there that they've got really old homes that really aren't worth much. And, maybe they've been the troublesome tenants that haven't been paying their rent. Once we go in and say, hey, you've got to either pay or you don't stay, they might just abandon that home. So that does happen every once in a while. They might just walk away and they won't even try to move it because they know it's not worth anything. Now, that does happen, but that's not the norm.
Yeah, well, that's definitely a unique benefit to mobile home park investing that you don't get with typical buy and hold real estate. Any other real benefits there?
Yeah. So again, I mentioned the barrier to entry. That's a big one because they're not building these anymore. So when we find a park in a marketplace that has a high demand for affordable housing, I don't have to worry about a developer coming down the road and building another mobile home park. And so we've got this, this barrier, this insulation around us that you just don't have to worry about competition moving in. A couple other big benefits is, again, it's expensive to move these homes. And so we don't have the turnover like you might have in an apartment complex. They're a little bit easier to manage because you're not managing the toilets and the termites and all the things that might go wrong with a rental unit. You're basically just in charge of the infrastructure. So it's our job to maintain the water and the sewer lines, the streets, and the common areas. And that's it. If anything happens to a tenant's air conditioning unit, their roof, or their plumbing, they don't call us. So we don't get those calls in the middle of the night, or our manager doesn't get those calls in the middle of the night. It's their problem. And so that's a big benefit. And then, there's lots of benefits, but one of the other big ones that we like is, again, comparing apples to apples, which is kind of hard to do, Keith. But if you took in the same market, a C-class apartment building and a 2.5 or 3-star mobile home park, both 100 units in size, you would typically expect about a 1.5 to 2 point yield premium as far as returns are concerned that you would get from that same mobile home park versus that apartment complex. And so the returns are typically a lot higher.
Okay. Yeah, that's pretty significant. Now, when I think about an investment, I always think about things at the lowest level. Who are we serving? Who's that tenant we're serving? Because we're thinking about what motivates them to live within a certain geography, in migration, out migration, job growth patterns. So I guess, why does a mobile home park resident say that they would rather live there rather than live in an apartment? Is it because they feel like they have ownership of something?
Yeah, that's one of the big benefits. In fact, when we buy a new park, one of the things that we do if we've got units to fill, we got lots to occupy, we do a lot of marketing to C-class apartment buildings, because what we find is that basically here's the scale. If you can't afford to live in an A-class apartment building, you live in a B-class. You can't afford to live in a B-class, you live in a C-class. If you can't afford to live in a C-class, or maybe you can afford to live in a C-minus, but your next step after that's like a D-class, which is kind of war zone-ish. Well, in that negative or in that C-class minus range, your other option as well for about the same price, if not slightly less, would be a mobile home community. And when people actually realize what the benefits are that exist in a mobile home community versus that apartment that they're in, a lot of times it's not even a sale. You don't have to sell them on the idea. And so what they get, aside from being an apartment, is they get basically their own space. They have their home that they own. They can put Christmas lights outside if they want. They've got a porch that they can hang out and grill on. They've got a yard for their kids to play in. They've got a designated parking pad sometimes with a carport above it for their cars. They don't get that in an apartment complex. What they also don't have in a mobile home is they don't have tenants above them, below them, and on either side that run their vacuum at 1 o'clock in the morning. They don't have that. And so for the same price, if not less, they can basically own their own home, or they can rent a C-minus class apartment building. And what we found is when we go and we market in a particular marketplace for new tenants or new residents, we go after C-minus class type apartment complexes. We do a lot of door hangers and direct mails, and we get a good amount of tenants from those places. So once they realize that this is an option for them, a lot of times they take it. Prior to that, they didn't realize it was an option.
Yeah, I think there are some people out there that would actually want to live in a trailer, even if it's less aesthetically pleasing than a C-class apartment unit, just because it is theirs and they do have that autonomy and they do have that open space, and they just don't know how else to get that with what they can afford.
That's exactly right. And another benefit is there's typically a community aspect in a mobile home park. Since people own their homes, there's less of a transient nature. And so in an apartment complex, very few people get to know their neighbors because their neighbors are coming and going. They might be there for a year, maybe 2 years, but you live beside these people and above and below them, but you never get to know your neighbors in the apartment complex. In a mobile home community, it's a little different. A lot of these tenants have been there 3, 4, 5, 10, 15, 20. I mean, we have some tenants in some of our parks that have lived in the community for more than 30 years, where literally the home that they're in might have been their mother's previously, and their mother sold it to them. Now they live there. The kids live there. And so I mean, it's like living in a normal single family neighborhood or a subdivision is really what it comes down to.
Yeah, it's touchy-feely, but that stuff matters. People really like to have a sense of community and a belonging in their life, and that does keep them in a place longer. The neighborhood that I live in, even, Kevin, it's kind of a higher-end neighborhood, but I don't get to know the neighbors because everyone has a garage. Here in Alaska, everyone just drives into the garage, and you never even get to see your neighbor. So that sense of community, yeah, I don't think that can be understated, especially when it comes to satisfaction and living in one place for quite a while. Well, we're kind of talking about the site here more, the setting. I'm sure we all have this mental image of a mobile home park in our head. Just tell us a little bit more about the management. Does a park need to be a certain size before you have on-site management?
Yeah, we have a minimum criteria. There's a certain class of a manager that we want to be able to afford. And so what we found, just on average, the size that we really need is about 40 spaces or 40 lots in order to justify having a full-time manager live inside the park and pay them to basically be our eyes and ears and run the show. Now, there's some exceptions to that rule. There's certain parts of the country that demand higher lot rents or higher rental rates than others. And so, for instance, our smallest park that we own today is a 35-space park in Atlanta, which is the first example I had given you about that, handlebar mustache mayor that tried to scare us. That park is only 35 spaces, but the lot rents they're significantly higher than lots of other parts of the country. I mean, they're $350 a month. And so we actually have as much revenue from that park as we might from a 50-space park in Raleigh or Greensboro, North Carolina, for instance. And so in that park, we have a full-time manager. They live there, but that's about the smallest. I don't think we would ever consider a park smaller than that. In fact, we probably wouldn't even buy a park of that size now. That nowadays 50 spaces is about our norm.
What are the management costs typically?
The kind of general rule of thumb, and it's about $10 a lot plus free housing. And so we provide them a house. We provide them utilities, we provide them a cell phone, and then we pay them about $10 per lot per month. And so 100-space park, they would get $1,000 a month plus a free house plus utilities, so their electric and water included, and a cell phone. In some parks, there are rental units, okay? And so some parks actually come with physical trailers that are owned by the park themselves. And so we buy parks sometimes that come with rental units that our goal is to convert them, but initially we own them. And so there's a little bit more work required with a park that has rental units in it versus a park that just where the tenants own their own home and they pay lot rent. And so typically you're looking between, like, use a rule of thumb, about 3 to 5% is kind of like a general range of gross income. Like that's what you should be able to justify, or that's what you should plan on paying as far as management is concerned. And that's going to vary based on, do you have a park that is all tenant-owned homes where they're just paying lot rent? So that management job is a lot easier and less demanding than a park that, let's say it's a 100-space park and 50 of the units are tenant-owned, that they just pay lot rent and they're maintaining their own units. And then the other 50 are rental units where you're basically handling tenants, toilets, and termites, right? And you're dealing with all that like you would a normal single-family residence or apartment building. So in that scenario, you might actually pay your manager slightly higher. It might be on the higher end of the spectrum.
Yeah, sure. Well, I think a lot of you are probably finding this really intriguing right now. And you know what, Kevin? I go to these real estate investing events, and every once in a while I run into a certain investor, and I ask them about themselves, and they tell me that they're a mobile home park investor, and they will typically talk about it so passionately, and sometimes they say that that's all that they want to do anymore, that they know there's got to be something to this here, and I think we're finding out more about that today. Well, I want to come back with Kevin in a couple minutes. I want to ask Kevin about how it works with the utilities in parks, what the financing terms are like, and how you can identify a park. You're listening to Get Rich Education. Our guest is Kevin Bupp. More when we come back. I'm your host, Keith Weinhold. Are you looking to invest in your first investment property or grow your existing inventory? Highlands Residential Mortgage can help, offering down payments as low as 15% and credit score requirements down to 620. Their streamlined process is designed to help investors close their loans quickly and without any surprises. You need someone who knows cash flowing real estate and can help guide you through the muddy waters of today's lending environment. So call Graham Parham today, toll free at 855-326-6802. The Parham team can help you purchase or refinance any of your 1 to 4 family investment properties.
NMLS number 195724, 12001 North Central Expressway, Suite 750, Dallas, Texas 75243. Equal housing lender, not licensed in all states.
As a lot of investors know, multifamily real estate has been one of the best asset classes to be invested in most of the last decade. While the great deals have been harder to find lately, there are still opportunities in select markets where savvy investors can get lots of appreciation and strong cash flow if you have a great team. Dave Zook, founder and president of The Real Asset Investor, and his team have been very active in the multifamily space in Memphis, Tennessee. On the heels of the Great Recession of 2009, Dave and his team quietly started acquiring multifamily assets, and in the last few years, he has syndicated over 2,000 apartment units, creating strong cash flow streams and big appreciation for lots of their investors. It's not too late to get involved. If you're an accredited investor and you would like to learn more about investing in great multifamily apartments with a world-class team, email Dave and his team at info@therealassetinvestor.com.
Hey, this is Dr. Buck Joffrey, host of Wealth Formula Podcast. You are listening to the powerful Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education with our guest, Kevin Bupp. So, Kevin, tell us some more about how does it work with the utilities there in a mobile home park?
Yeah, so utilities, there's two different types of utilities. Basically, it's either public utilities or private utilities. Public utilities is either provided by the county or the city, or if it's a local utility provider. But either way, it's coming from a main source. It's not a well or a septic or something like that. So private utilities would be something along those lines. It'd be a well for water. And then the sewer could either be a septic system. It could be what's known as a lagoon. In case you've never heard of a lagoon, basically it's a big cesspool where all the waste goes. We don't like those too much. And then there's also on-site treatment plants, like sewage treatment plants that some parks have as well. Now, our preference, because it's just less risk and less maintenance, is having public utilities where they're actually provided from a city or a county. But we do on some parks that are on private utilities as well, at least have a private utility component. And so typically how it works, I'm going to speak to the public side because it's easier to understand exactly how everything's structured on the public side. Now, a lot of these parks were built 50, 60, sometimes 70 years ago. I'd say the largest population of parks were built in like the 60s and 70s. That's where a majority of them came online. Now, there's some built in the 80s as well, in the 90s, and some back in the 40s, 50s, and 60s. But the 60s and 70s is probably the largest year for construction. Back then, water and sewer, it wasn't expensive. It wasn't expensive. It wasn't something that really people thought of. It wasn't really factored into like their monthly expense. It was, but it wasn't a big chunk of it like it is today. So back then, a lot of these parks were built where they had like literally a master meter at the front of the park. And then just including the lot rent, they included water and sewer. And so the park owner would pay for the water and the sewer usage, and basically included in the lot rent, the tenants get to use as much as they'd want. It didn't really matter. There was no kind of meter or anything like that on it. Well, the times have changed a lot where those utilities have gotten a lot more expensive. And so typically what's happened, either it's currently in place or we put it in place when we buy a park. But now most of the lots are individually metered to where the tenants would handle and pay for their own usage each and every month, just like you do in your own home. Your own home is going to have a meter on the outside. The water company comes by and reads that meter and charges you back based on a formula for the water and sewer usage. Same thing applies now in mobile home parks. And that's actually one of the big upside potentials that we look for. We look for parks that are, run by mom and pop still, that maybe they've never gone in and actually sub-metered the usage. And that for us, that's a massive savings that goes directly to our bottom line. Right. Because we'll go put meters in each one of the lots, and then we will literally use the same formula that the local water company uses, and we'll bill them back for the water and sewer usage. And go around and read it each month. Our manager goes and reads it, and we bill them directly for it. And so that's typically how they're set up. And so some parks actually already have meters, some don't. But that's exactly how the utilities are typically structured.
Yeah, I would think the public utilities would be significantly more preferable to the private. Yeah, with the private, with you having your own well and all the other systems, I just think of more expense, more risk, more management costs, and just more, things to be worried about that could go wrong.
Yeah, the well actually is the biggest concern, and same with the sewage. But, there's so many regulatory changes that you're always, everything's always changing. The water quality standards are always changing. And so with a well, that's really the scariest for us. We typically would never even consider a park that was on a well unless I'm saying that because we actually have a parking contract today that's on well, but there's a city connection right at the front of the park. They just haven't been forced to tap into it yet, but it's there and it's available. Same with the sewer. This particular park is on septic, but the sewer is at the front of the park, meaning that there is a backup plan in place right there. Just no one's ever really tapped into it. And so the well scares me because you're basically, if you ever have any kind of infiltration into that well system, you're poisoning people. I mean, you have the ability to actually poison people, which is very, very scary. And it can happen. There could be infiltration underground that gets into that well, and you might not know it until it's too late. And that's just the major liability that we do not like. On the sewer side, we have multiple parks that are on septic systems. But again, we wouldn't have bought those unless there was a backup plan. And so our backup plan is that the sewer is at the front of the park. The main sewer line from the city or county is there. And so we could tap into it if the day comes where our systems are failing or we're spending too much money on that, maintaining the private sewer system.
Yeah, it can be pretty tricky with the well. I think as an investor out there, when you're thinking about buying a property, looking at a property and you see that there's a well on it, that immediately attracts you because you see that reflected in a profit and loss statement that there isn't any expense there for your drinking water, but there are ongoing well costs, as I know, with properties that I have wells on. And yeah, besides the ongoing maintenance costs of the well and getting it tested, yep, there is that risk, isn't that you never know what is going to get in there. And you're the one, it's not your manager, it's you, the investor, is the one that's ultimately responsible for the health and safety of those tenants. So, well, that kind of leads us into asking you about financing, Kevin, because I want this to be an approachable investment for people. Can you get financing if there are private utilities? And how does financing work overall, whether it is public or private utilities?
Yeah, you can absolutely get financing, either if it's public or private utilities. I'd say mobile home parks, let's compare it to apartments. Most banks understand multifamily, but when they understand multifamily, they understand apartments. There's a lot of banks that just don't even get mobile home parks, or
right.
That negative stigma has infiltrated the bank. And so all they think of is, oh my God, we are not lending our money on this crazy park that's in town. Like we're not doing it's too much of a risk. But here's a funny fact for you. Actually, not funny, but it's just an interesting fact for you, Keith, and all your listeners. During the recession or the crash of 2008 and leading into 2009, 2010, mobile home parks had the lowest default rate of any commercial asset type. So multifamily, office building, retail, self-storage, mobile home parks had the lowest default rate. That's pretty powerful. And so a lot of banks, they just don't understand it. The banks that do get it, they love them. They absolutely love them. And so it's tough sometimes because you'll go into a market. We backed out of deals because we'll go into a smaller market and there's maybe only 4 or 5 banks that we have access to that will lend in that local marketplace. And if none of those banks get it or we can't get them on board with this asset or with us as borrowers or both combined, then we're out of luck a lot of times. So that's happened once or twice and not often. But the more common way to buy these parks, which is one of the very attractive things to this asset class, is about half the parks in the U.S. are still owned by either the original mom and pop or the second owner. And if they were built 40, 50 years ago, there's an aging population of owners that are literally aging out of these assets. In fact, we find a lot of mom and pops, they live in the park or they run the park on a daily basis. Like they don't have an on-site manager. They are the on-site manager. In fact, 5 of the 7 parks we bought in 2016 were owned by mom and pops that had literally owned them for more than 25 years minimum. Okay. And they basically ran it themselves. And so a lot of them own them free and clear. And a lot of them, they're used to the cash flow. And they've also got a very, very low tax basis, meaning like the capital gains are going to be substantial when they decide to sell. And they're also going to lose that cash flow or that income stream. And so all but one of the deals that we purchased in 2016, we got owner financing on. We were able to negotiate owner financing with the seller. And so it's an interesting asset class because there are a lot of parks owned without debt on them, and they're owned by aging population or an aging owner that owner financing makes a lot of sense for them. So that's how we finance the majority of our parks is with owner financing. We do get bank financing when we have to. Can be challenging sometimes, but it's available. It's definitely available.
Yeah, well, it sounds like there's really a lot of opportunity there potentially with seller financing being one of the main sources of capital. If you do get a bank loan, what are the % down and duration terms that they're looking for?
Yeah, kind of our preference is we see anywhere between 25 and 30% down, 20-year amortization. Every once in a while, you might find a bank that's willing to do a 25-year amortization, but typically it's 25, 30% down, 20-year amortization with either a 5-year balloon or a 5-year reset, depending on what index it's tied to. That's kind of the norm. And right now rates, I just talked to a banker earlier today on a park we have in contract up in Buffalo, New York. And they just gave us a term sheet of like 5.25 with 25% down, 20 amortization with a 5-year reset on it.
Okay.
So, yeah, pretty standard commercial loan.
So when we talk about something that's often seller finance, that just makes me think about the term just superficially, how do you find a park that's for sale?
There's multiple websites out there. Maybe not everyone, but a lot of people know about LoopNet. LoopNet's basically the commercial MLS, you could call it. And so there's a category in there. You can find mobile home parks for sale in there. It's probably not the best place to look. Not to put LoopNet down, but I kind of call it the broker trash can. It's kind of where deals go to die. Most of the deals that make it there, they've already been shopped to everyone or to a buyer's list, and they're overpriced or they have some kind of underlying inherent problems to them. But there can be deals here and there on LoopNet you can find. So that's one of the big places you can find deals that are actually for sale in the marketplace. There also is a big website called mobilehomeparkstore.com. That is probably the largest listing site for mobile home parks. But other than that, that's about it. And I can tell you that commercial real estate in general, so not just mobile home parks, but it's completely different than residential real estate, than single family homes, in that with residential real estate, majority of listings happen on market, meaning they actually get listed and they sell through the MLS or through a realtor. Commercial real estate is completely the opposite. Majority of the actual sales or transactions happen on off-market deals.
Sure.
They never make it to market. And so we have our best luck going direct to market. We spend a lot of time researching markets, analyzing markets we like, and basically going direct to owners, really just building rapport via direct mail or cold calling, and just staying in contact with owners that we know that own a park that we like based on the size or based on the location. So every single deal we bought last year in 2016 was off market, direct to owner. We didn't buy a listed park at all.
Yeah, I'm not surprised. So in a sense, it's really not so much about finding a deal as it is about making a deal. And a lot of times when seller financing seems to be either the only option or one of the best options, it's often incumbent upon that prospective investor to go ahead and educate the owner of that park as to what the benefits are of selling that park to you. And that way they don't have to pay a big capital gain, lump sum, and so on.
That's exactly right. And we never go into a deal. I never, ever go into a deal or negotiation with a park owner, a seller, talking about owner financing. Normally, we just talk about the pricing, the value, and come to some kind of, try to get to a point where we agree on the actual value of the park and what we might be able to buy it for, right? Or what they might be willing to sell it for. Owner financing discussions typically come in after we've already had the property tied up, after we get to meet the owner a couple times in person and have a discussion with them, ask them, what are they going to do with their money? What are they going to plan on doing with their money? How are they going to replace the cash flow after they sell this thing? We start having little probing conversations or bring up points like that with, regarding capital gains. What are they going to be happy about paying Uncle Sam this amount of a tax hit? And it starts piquing their interest a little bit, those little tidbits. And typically we kind of go into a owner finance conversation at that point in time if they haven't already thought about it or considered it. And we're typically able to convert, a large majority of them. When they really start thinking about it and they go talk through the CPA then and find out that they're going to be paying such a large chunk to Uncle Sam, it makes them not very happy. And they know that they don't want to continue running the park. And so they're on board with selling, and they realize that they're going to lose that cash flow each month. And they're also going to give away, a big chunk of their sales proceeds to Uncle Sam. It starts looking a lot more attractive to owner finance the park.
Yeah, you subtly make apparent to them what those pain points really are. And to that older investor that's owned that park for a long time, this could just look like a really attractive exit to them.
Well, here's the thing. They know the park better than anyone else, right? So they're basically going to get a return on an asset they know better than anyone else. And they're going to get a return that is probably 3 or 4 times higher than what they would get just by sinking their money into a CD or some other type of, market investment. So it's almost a no-brainer when they really start looking at the whole picture. Their biggest fear, here's where the biggest fear is. The reason why they don't even ever consider owner financing up front is they're selling the park. They do not want it back. If they're aging, the last thing they want to do is move down to Florida and join the country club and be out on the golf course and find out that, Mr. New Buyer defaulted or he hasn't made this month's payment or he's given the park back to me, because they don't want to move back up to wherever they just came from to get away from that park. And so that is their biggest fear. And so as long as you can overcome that fear and make them feel confident in yourself as a park owner and operator, a lot of times that's the biggest part of the sale right there.
Yeah, well, I'm sure this is piquing quite a bit of interest. As an investor, as one goes on in their lifespan and they gain more experience with being an investor, I think one gets increasingly interested where they get a good return on their time invested. You've heard me talk about that before, Kevin. What's your return on time invested? It sounds like there's some good opportunity here. It sounds like there's quite a few touches, and this could really take a lot of person's time or mental bandwidth to at least acquire the park. And then afterwards, maybe things are on cruise control if you have the right manager. Can you talk some more about what one's return on time invested might be with this?
Our approach is one approach, and it's not the only approach, in terms of how we find parks and how we buy them. I know many people in the industry that only rely solely on brokers. There are specific brokers that specialize in this asset type. And so I have friends that are in this industry that buy parks just like we do. They spend all their time focusing on broker relationships and let these brokers bring them deals. That works for them. A lot of times I would rather not wait for a deal to come to me. I go after it. And so that's just our preference. And You are right, though. It can be very timely. A lot of times when we reach out to a park owner, they're not ready to sell today. When we make the call or they get our direct mail piece, they're not ready to sell today. And so it becomes an ongoing rapport building process. And that can last many years. We bought a park in 2016 that we had started an initial conversation with that park owner. I reached out to her about 2 years prior. So it took 2 years to get to the closing table with her because she just wasn't ready to sell initially. Now, timing is everything, right? And so I think as long as you're marketing on a consistent basis and you're making those calls, you're going to make a call one day and you're going to find that, hey, I just called at the right time. This guy was just talking to his wife about selling last week, and I just happened to call before he listed it with a broker. And so a lot of times they can come off pretty quickly, and sometimes they might take multiple years. So there can be a significant time commitment there. And if you don't have the time to do the approach that we take, you could simply build relationships with brokers and let them do what they're best at, which is go track down deals, hunt down deals, and bring them to you. Okay. So there are other easier alternatives. And I say that like LoopNet's a needle in the haystack, meaning like it's hard to find great deals there. Well, in 2016, we didn't buy any deals off LoopNet. I still search it. I search it on a regular basis, but I didn't buy anything off LoopNet last year. It just happens that in 2017, we have 2 parks in contract right now that I found on LoopNet. And they're actually, one's definitely going to go. One's a phenomenal deal. The other one I don't know too much about yet because we just got it tied up. So those were very easy. I mean, those were literally a matter of filtering out a search, calling the broker. They were already on the market for sale. They had the financials ready. And I spent maybe about 2 weeks on doing research before we had them under contract and locked up. So time commitment can be a lot. It can be very little. It just depends on which approach you take. Now, as far as the ownership side goes, again, a lot of that can depend on the type of asset you're buying. We buy a lot of distressed deals. And so we like to have a lot of meat on the bone, meaning like we like to put a little bit of, sweat equity into them so that the back end is substantial as far as returns go. Now, this is what we do full time. And so this is our business. And so we've got an infrastructure that can support that. And so for us, the time is worth it. Now, someone that's a doctor or a lawyer or a busy professional of any type that only has part-time to do this, maybe they want to buy a more stabilized park. And so there's plenty of parks out there that are run by people like us that are exiting out of a park. Like maybe we've already turned it around. We've already stabilized it. We've got the infrastructure in place. We've got good quality tenants in there. They're paying on time. The occupancy is up. Everything's on autopilot. Maybe they buy a park like that. There's plenty of opportunities out there on stabilized deals that literally will take very little of their time. Very, very little. Now, the returns might not be as high, but they're very stable deals. And they probably won't take much of their energy whatsoever because they're already running on autopilot and they're running very smoothly. So I think you could have a very large time commitment on one side, but also a very minimal one, depending on what kind of property you want to buy and how you want to approach it.
Yeah, I oftentimes try to make things as turnkey as possible for my listeners. With that in mind, are there syndicators out there where someone else can come in and go ahead and have their money aggregated into a larger deal?
Yeah, absolutely. In fact, we're about to roll out a fund here in a week and a half. So we syndicate. There's multiple other syndicators out there as well. And it kind of runs the spectrum of different types of parks that they purchase or different geographies of where they buy their parks in. And so, yeah, there's multiple syndicators out there where people can get involved on a passive level to where they can just get their money to work in an asset class. If they like this asset class, they can get their money to work in a passive form to where it doesn't take any of their time, So there's lots of options out there.
Yeah, well, this sure is an intriguing investment class where you as an investor are just basically renting the plot of land and there are less moving parts and things to have to be responsible for that way. Kevin, is there any last thing that maybe I should have asked you but didn't?
We talked a lot about parks that all the homes are just owned by the tenants. Okay. And so there, like I had mentioned, I did allude to at a certain point in the show here that there are parks out there that actually come with rental units as well. And so there is one big thing here. I see a lot of new investors make a mistake here. They'll see a park, it's for sale, and it comes with a certain component of rental units, meaning that the park owns some of the trailers. And what a lot of park owners do, uneducated park owners that might own the park currently with these rental units, they actually capitalize the rental income of the trailer. So what I mean by that is there's an underlying lot rent. So every lot has a lot rent associated with it, right? And then there's a difference between the lot rent and the amount that the trailer is being rented for. So if it's a park-owned trailer, maybe it's selling or maybe it's renting each month for $500, but the underlying lot rent's only $200. Well, then there's that $300 spread there. That would be the rental amount for that trailer itself. The wrong thing to do, and a lot of owners do it when they're selling, it makes the numbers look phenomenal. They basically treat it like an apartment complex and they capitalize that $300 rental income. And that makes the numbers look awesome. It really does. But I can tell you that if you capitalize that $300 and put a realistic expense ratio associated with it, the value you get for that trailer is going to be much higher than what that trailer is really worth. In fact, more commonly, 2-3 times more than what that trailer is really worth, or what you could really sell it for if you wanted to turn around and sell it to an end user. And so the right way to evaluate these parks is to really look at the lot rental portion as a separate business, capitalize that income, and then associate just a whole market or wholesale value to the trailer inventory. So if you're acquiring some rental trailers in that park, just capitalize the lot rental portion of the entire park, and then look on NADA.com or just look in the marketplace and find out what that kind of trailer, that year range is selling for, and evaluate them that way. And you're going to find that it's going to be a lot less of a total evaluation than what a lot of sellers might be asking for them. But that is the right way to evaluate parks of that nature. And I see a lot of investors make big mistakes by overpaying for parks because they're capitalizing the rental income of the actual trailers themselves when the park's actually being sold with rental units. So big mistakes.
Right. That's certainly something to look out for. Well, Kevin, how can our listeners find out more about this?
I've got 2 different websites. One is called the Mobile Home Park Academy. So they can visit at mobilehomeparkacademy.com. We do a weekly podcast on mobile home park investing. So each and every week, me and my business partner either do a solo show where we talk about a relevant topic pertaining to mobile home park investing. And then we also bring on experienced park operators, and we interview them about their business, how they got into it, and the different types of parks that they're involved in. So they can learn a ton from them shows. The shows are very granular in nature. We cover a lot of very in-depth topics. So they can go to my website, mobilehomeparkacademy.com, listen to the previous shows, and then they can go to my main website, kevinbupp.com, and I've got a lot of podcasts on there as well. I do another commercial real estate investing show where I've also interviewed, mobile home park investors and other types of real estate investors. But they can contact me through either one of those sites. They can learn a lot about my business and just mobile home park investing in general by going to both those sites.
Kevin Bupp, it's been insightful. Thank you so much for coming on to Get Rich Education.
Keith, thank you so much for having me.
All right. Yeah, Kevin and I are each native Pennsylvanians. We're both runners and we're both real estate investors. Yeah, Kevin brought up some really good points with mobile home parks and how residents stay in place for so long. I mean, the fact that tenants stay longer, that right there, that's one reason I like single family income properties over apartments for a lot of people. Okay. That's because tenants feel like the place is their own in a single family home or a mobile home park. And that way they stay longer. And that long-term tenant retention, that's so key because as real estate investors, we know that our greatest expense is vacancy and turnover. Nothing cuts our cash on cash returns like that. So just like single family homes, mobile home parks can be a great way to tilt that metric into our favor. Check out Kevin and his resources. Next week, we've got such a trusted guest joining us in a favorite topic of mine to talk about. It's a way to create cash flow for yourself that you've probably never even considered and didn't even know existed. It's just going to be such a rich, vibrant show there next week and really educational too. This is Get Rich Education after all. In 2 weeks, Rich Dad Poor Dad author Robert Kiyosaki joins me here on the show, and I know that you're going to find that inspiring too. On behalf of my team that's been with me here since day one, Get Rich Education's developers, John Collins and Marcus Whelan, sound engineer Vidran Jampo, GetRichEducation.com's web designer Nikon Roy, I'm your host Keith Weinhold, signing off from tropical Bridgetown, Barbados today. Though you might quit your day job, don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A-plus rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.